Welcome to Talk Tickers.
Thanks for tuning in.
Today we're diving into Altria Group's first quarter 2025 earnings call.
Yep.
We'll cut through the jargon, get straight to what matters for you as an experienced investor.
Okay, so the quick snapshot. It's a bit of a mixed picture, really.
How so?
Well, their smokable products segment, the traditional cigarettes, it actually showed pretty solid adjusted operating income growth.
Driven by Marlboro, I assume?
Mostly, yeah. Marlboro's strength was key there.
Okay.
Then you've got the oral tobacco side on nicotine pouches, still seeing really good momentum.
Even with all the competition out there.
Even with the competition, it's definitely holding its own and growing.
Good news for them.
And for shareholders, too. Strong cash returns continued. Dividends, share buybacks, the usual.
Right, but wasn't all positive, was it?
No, definitely not. The e-vapor category, that remains a, let's say, significant challenge.
The illicit disposables problem.
Yeah, Clay, that illicit flavored disposable market is just persistent, a real headache for them.
And what about the outlook, the guidance?
They set the full-year adjusted diluted EPS guidance for 2025 between $5.30 and $5.45.
Which is what kind of growth?
That represents about 2%, 5% growth, but keep in mind that's from a 2024 base that they had to recast.
Ah, right, because of that change in how they account for amortization expense.
Precisely. So $5.19 is the adjusted base from last year.
Okay, let's dig deeper then. Starting with smokables. You said income was solid, but what about volumes? That's always the big question.
Yeah, absolutely crucial. So adjusted OCI, the operating income, was up 2.7%.
Nice margin boost, too.
Oh, yeah. Adjusted OCI margins hit 64.4%. That's up a hefty 4.2 percentage points year over year.
Wow. How did they manage that with volumes likely down? Prices.
Bingo. Strong net price realization, 10.8%. They're definitely charging more.
But the volume side?
That's where the story shifts. Reported domestic cigarette volumes, down 13.7% in the quarter.
Ouch. That sounds steep. Any adjustments there?
Yeah, they estimate it's more like a 12% decline when you adjust for calendar differences and, trade inventory shifts.
Still double digits. How does that compare to the whole industry?
The overall industry decline is estimated at around 9%, adjusted. Yeah. So Altria's decline was a bit steeper.
Why the bigger drop for them, do they think?
They point to a couple of things. One, as we mentioned, the boom in those illicit flavored disposable vapes pulling smokers away.
Right.
And two, just continued pressure on people's wallets, discretionary income being squeezed.
Makes sense. Are people trading down?
It seems so.
Yeah.
The discount cigarette segment actually grew its share by 1.8 points. That suggests price sensitivity is definitely a factor for some smokers.
Okay, so what about Marlboro specifically? It's the premium brand, the core. How's it faring?
Interesting story there. Marlboro's overall retail share dipped slightly.
Uh-oh.
But, and this is key, its share within the premium segment actually ticked up by 0.1 points to 59.3%.
So it's holding its ground against other premium brands.
Exactly. Management seems pretty encouraged. They think the brand's positioning is strong, and they're using their revenue growth management tools and data analytics pretty effectively.
Meaning?
Meaning they can offer targeted support, like promotions or pricing adjustments, almost down to the store level, rather than just broad national strategies.
More granular.
Yeah. In fact, they've stopped reporting that national average Marlboro price cap figure.
Why is that?
Because they say they manage pricing so locally now, store by store, that the national average isn't really relevant to how they actually operate.
Gotcha. Okay, let's switch to oral tobacco. You said on-end is the star.
Absolutely. The whole segment delivered over $400 million in adjusted OCI in Q1.
And margins.
Really strong. 69.2% adjusted OCI margins there.
Wow. But I thought overall segment volume was down.
The total reported shipment volume for the segment decreased by 5%. But that's because the growth in on-end was offset by lower volumes in traditional moist smokeless tobacco, or MST. When you adjust for inventory and calendar stuff, they estimate the segment volume decline was only about 1%.
So on is really carrying the weight.
Completely. They estimate on-end drove basically all the growth in the entire oral tobacco industry volume over the last 6 months, about a 10% increase for the industry.
And on-end's own share.
It grew 8.7 share points just in Q1. It's now almost half the entire oral tobacco category by volume.
Incredible growth. How many cans are we talking?
Over 39 million cans shipped for on-end in the quarter. That's up 18% year over year.
And its share within the oral tobacco category overall.
up to 8.8%. That's a 1.8 share point increase from last year.
And within just nicotine pouches.
It hit 17.9% share there,
Yeah.
gained about half a point year over year.
And you mentioned they did this while spending less on promos and actually raising prices.
Yeah, which really suggests the brand equity is strengthening. Consumers are seeking it out.
But its on-end campaign seems to be working then.
Seems like it. Consumer impressions apparently grew almost 5 times year over year. Awareness among actual pouch users is over 60%.
So the plan is just keep pushing on.
Pretty much.
Yeah.
Helix, the subsidiary, plans to keep investing in the brand, build on this momentum.
What about the traditional MST brands like Copenhagen? Still important.
Oh yeah, Copenhagen is still a major profit contributor. It's a leading premium MST brand, generates significant OCI.
Okay, so oral's looking strong. Let's pivot back to the problem child. E-vapor. You mentioned the illicit market dominance.
Right. It's huge. They estimate over 20 million vapors now, and illicit products make up over 60% of that category. Just massive.
And that directly hit their Enjoy Ace product, didn't it?
It did. They had to stop importing and selling Enjoy Ace wholesale at the end of March.
Why again?
There was an International Trade Commission exclusion order, basically a ruling related to patents held by a competitor, plus cease and desist orders.
So legally blocked for now.
For now, Enjoy plans to appeal, and they're apparently working on a product redesign to address the patent issues.
But the financial hit was big.
It's huge. A non-cash impairment charge of $873 million related to the goodwill from the Enjoy acquisition, basically writing down the value because of these market shifts and legal issues.
Oof. So is the Enjoy acquisition basically a bust?
Well, they don't see it that way entirely. They argue the acquisition still gave them valuable assets, capabilities, for building a future e-vapor pipeline.
So the strategy now is what? Learn and wait.
Kind of. Learn from what consumers seem to like about disposables and build out a pipeline of innovative, potentially regulatable products for when or if the market gets cleaned up.
And are they trying to accelerate that cleanup?
Very actively. They're pushing for regulatory reforms, faster FDA product authorizations, much tougher enforcement against the illicit players.
Wow.
Lobbying Congress, talking to the administration, supporting state laws like directories of legal products. State AGs are also stepping up enforcement, apparently.
Do they think the FDA can fix it?
Management's view is yes, the FDA has the tools, expedited authorizations plus forceful enforcement. It just needs to use them more effectively.
What about synthetic nicotine? That was a gray area.
Yeah, their view seems to have evolved a bit. They acknowledge the FDA seems to be showing, let's call it enforcement discretion there. So Altria is now looking at potential opportunities with synthetic nicotine too.
Interesting shift. And the China tariffs, any impact?
Tariffs are on now for products from China, including disposables. But it's still early days to see the full impact on availability or price. Altria kind of hopes it might lead to better border enforcement, actually.
Okay, moving to other financials. Anything else stand out? Their ABI stake.
The earnings from their stake in Anheuser-Busch InBev were down about 11.5% to $146 million. But that was mainly because they own a smaller percentage now.
Still just a financial investment for them.
That's the line, yeah. Goal is to maximize its long-term value.
And capital returns. You mentioned dividends and buyback.
Yep. In Q1, about $1.7 billion paid out in dividends, and they bought back $326 million worth of shares.
How much is left on the current buyback plan?
About $674 million. They expect to finish that by the end of this year.
And their debt levels.
Looking okay. Total debt to EBITDA ratio was 2.1 times at the end of March, which is right around their target of about 2 times.
So back to the guidance, the $5.30 to $5.45 EPS. What assumptions are baked into that?
Key assumptions are enforcement efforts against illicit products won't have a huge impact on their own cigarette or legal vape volumes this year.
Okay.
And they're not assuming Enjoy Ace comes back to market in 2025.
What else?
It also includes plans to reinvest cost savings from their Optimize and Accelerate program, and they expect lower income from pension benefits.
And the tariffs?
They factored in a limited impact based on what they know now, but they're keeping a close eye on how it might affect consumers and costs.
Got it. Any other unusual financial movements?
One thing is the settlement payments were lower this quarter. That's because a specific legal fund expired. They expect that trend of lower payments to continue for the first 3 quarters of the year.
Okay, so let's pull it all together. From an investor's perspective, what's the big picture here?
Well, first, you see the resilience of the traditional tobacco business, Marlboro especially. Even with falling volumes, the pricing power is immense, generating huge profits. That's your stable cash cow base.
Right. provides the funding for other things.
Exactly. And the second thing is on-end success. That strong growth and share gain in nicotine pouches really shows they can successfully move into alternatives. It's a genuine hedge against the cigarette decline.
The fact they grew on-in while raising prices is pretty telling.
Very telling. Signifies real brand strength. But then, number 3, you have the e-vapor mess.
Yeah?
The dominance of the illicit market, the enjoy setback. It just highlights the huge regulatory risks and how fast things change in smoke-free. So you need to watch their strategy there very closely.
How do they navigate reentry? How successful are they in pushing for regulation?
Precisely. Fourth, the maintain guidance is a sign of confidence, right? Despite e-vapor headwinds and volume declines, they believe cost cuts, pricing, and on-ends growth can deliver.
Plus, the shareholder returns continue.
Yep. Dividends and buybacks remain a core part of the story. Fifth, that evolving stance on synthetic nicotine. It's a potential new growth path, but also adds more uncertainty, more competition maybe.
And finally,
keep an eye on the consumer. The commentary about economic pressure, the growth in discount cigarettes, that matters. Consumer behavior could shift further, and those tariffs, still a bit of a wild card for costs and consumer spending.
lots to track there. Okay, time for our This Is Not Financial Advice segment. Give us an outrageous but plausible trade idea based on all this.
All right, so everyone's focused on Altria, or maybe the big vape players, but think about the problem those millions of illicit disposable vapes flooding the market.
Yeah, the enforcement challenge.
Exactly. So if Altria and others succeed in pushing regulators to crack down hard, what will they need?
More enforcement officers, better laws.
Sure, but technologically, how do you tell a legal vape from an illegal one quickly and reliably at the border or in a store?
Some kind of tracking or authentication.
Bingo! So the trade idea is go long on a company that specializes in cutting-edge authentication tech, like advanced QR codes, maybe blockchain-based supply chain tracking, microtaggants, something adaptable to small, high-volume consumer goods like vapes.
Betting on the tech needed for the crackdown.
Yeah, it's a contrarian picks and shovels play.
Yeah.
If enforcement ramps up seriously, demand for these kinds of verification and tracking solutions could explode, both from regulators needing tools and from legitimate companies wanting to prove their products are compliant.
Betting on the tech infrastructure for future regulation. Interesting. Not something most people are probably thinking about.
Plausible, right? If the regulatory hammer really falls,
Yeah.
High risk, maybe high reward.
Definitely fits the bill. A fascinating angle. Thanks for that.
Just then.
So, to wrap up our deep dive, Altria is navigating a complex transition. Strengths in the core cigarette business, and particularly in on-pouches, are clear. But the e-vapor segment remains a major hurdle, tied heavily to regulatory outcomes and combating that huge illicit market.
They're playing the long game there, it seems, focusing on product development and regulatory advocacy.
And adapting to consumer pressures and exploring new avenues like synthetic nicotine. So, what are your thoughts on Altria's strategy? Where do you see things heading?
Yeah, we always encourage you to dig deeper, form your own views based on the data.
Absolutely. Well, thank you for joining us for this deep dive into Altria's Q1 2025 earnings.
And just to reiterate, nothing we discussed constitutes financial advice. Always do your own research.
We'll be back soon with another earnings call breakdown. Thanks for listening to Talk Tickers.